Hi guys, today we're looking at Fibonacci retracements and Fibonacci extensions. Have you ever wondered why price movements reverse at seemingly random points? The answer is often Fibonacci retracements or extensions. So what is Fibonacci, how do we use it in trading? At its core, Fibonacci analysis in trading is based on a mathematical sequence discovered by Leonardo Pisano, also known as Fibonacci. This sequence creates unique mathematical ratios that appear throughout nature and remarkably in financial markets. In trading, we use these ratios as percentages to identify potential areas of support, resistance, and also price targets. The most commonly used ratios are, you can see here, 38.2, 50, 618, 786, and the 23.6. So these are the common retracement ones, and there's also extensions, which you can see here. So the 1.27, and the 161. And there's also 261. So there are two ways you can use Fibonacci. You can use Fibonacci for retracements and you can use it for extensions. So for retracements, we want to identify a trend. We want to see the market move in that direction. And then we want to see how far back the market retraces before it continues. So we identify swing highs and swing lows, and then we plot our retracement. So you can see the retracement would be here. So this is the swing high, this is a swing low, and then we're seeing the pullback here. So it pulls back to the 618 level. And then you can see this market moves higher. The area we're looking for this to retrace back to is ideally between the 618 and the 382. So we always kind of want to see the market come back into here. This is the standard retracement level. Any further, it's a deep retracement. Any not as far, it becomes an impulsive move and we see this market move quicker. Ideally, what we want to find is the market retrace into this zone, find an area of support, find a couple of other indicators, so candlestick analysis, price patterns, to signal this market's about to change and then trend higher. So how do you actually use it? It's about identifying a swing high, a swing low, finding a zone where you want to buy or sell, and then buying at that level. So let's go into a smaller chart and try and identify. So if we go down to a hourly chart, you can see this is cable trading down, and let's go into a slightly higher chart, 4 hour. You can see we've got a few swings. So 1 swing, 2 swing, and 3 swings. So we could argue there's a swing here. So we'd be looking at identifying this zone. You can see it tested into it, but we're just running into support here. So this would potentially be a sell zone. You can see actually we've got area of resistance here. So resistance, support, resistance. So if this market comes up to this level, this potentially becomes a good area to look to sell. Now, how do we use extensions? We can use them, if I go here, we go extension, and you go from the swing high in this case to the swing low, and then the swing. So we're saying back up to here. If the market comes up to this level, this is where we want to look to sell, and these are our targets. Right, so we're looking for any of these kind of levels down here as becoming a target. One of the ways I like to use it is I actually like to use the retracement, and you pull it here, and then you're basically looking for this 161. So if we get a sell around here, we'll manage to sell around here at resistance. You can put a stop loss either above the swing high and target the 161. So here you can see we've got a 2-to-1 ratio. As I mentioned, identifying a confluence of indicators or confluence of reasons to sell at a level is the best way to do it. Just simply selling blindly in this 38 to 618 zone can cause you problems because sometimes the market can come all the way back and sometimes it can obviously break these highs. At the moment, you can see there's a significant level of support here. So whether or not this breaks lower, what we might end up seeing is this market hit this again before it then comes up to our level up here and then move up to sell. Getting in too early can be dangerous. What we want to do is find several reasons to take this trade, not just rely simply on Fibonacci. Right, that's it for Fibonacci today. In our next episode, we'll look at exactly how you draw it. I hope you enjoyed it and see you next time.